So, chapter 10 is about liabilities. Learning objective one focuses on current liabilities. The objectives two and three talk about long term liabilities, specifically bonds. And then the last objective talks how we report and analyze liabilities. So, we're going to focus on learning objective one. It's a pretty big one, actually. It doesn't look like much, but it's pretty good size. You've already been familiar with current liabilities. Remember, on the classified balance sheet, you have two classifications of liabilities, current and long-term liabilities. So a current liability basically is a debt that needs to be paid within the current period, right? Usually 1 year. Um, we usually pay our current liabilities from our current assets. That's usually how we how we manage that. On occasion, we may not have enough current assets that are liquid to pay our current bills. And so on occasion, we might need to create other current liabilities to pay off current liabilities that we have that are due. Okay. So again, a current liability, that word current in accounting within 1 year is the important thing. You already been introduced to a whole mess of current liabilities from your days working on the balance sheet, the classified balance sheet. You already know about notes payable, you know about accounts payable, you know about unearned revenue, and you know a whole bunch of accrued liabilities like salaries and wages payable, interest payable, things like that. You are going to learn that it's a bit more expanded. It's a little bit more detailed um, than what you've already known. Several new accounts are going to be introduced to you tonight. But first, a review. Notes payable, right? The word note is a loan. This is a written promissory loan. It has an interest rate attached to it and a due date. Most notes payable are short term, which means most notes payable will be current liabilities. However, there will be occasionally notes payable that would go more than a year, in which case that would be a long-term liability. But again, most notes tend to be current. Um, Overwhelmingly, we use notes payable for short-term financing needs whenever we need to borrow money for a short period of time. Okay. So the other, well, the example for this you're pretty familiar with, but here's the illustration. First National Bank agrees to lend $100,000 on September the 1st, 2017, if Cole Williams Company signs a $100,000 12% 4-month note. Okay. And that note being 4 months means it's going to be matured on January 1st. So you know how notes work. Everything gets paid back on the due date, on the maturity date. So on January 1st, they will pay back the $100,000 that they borrowed plus the interest for that 4-month period. Okay. So when the note actually is issued, what's going to happen on the books on September the 1st, right? Well, basically, they're going to indicate, Cole Williams is going to indicate that they received $100,000 of cash. So a debit to cash account, a credit to notes payable, showing they have the liability for notes payable. Right. So what happens then if Cole Williams closes their books on December 31st? Well, this interest isn't due until January the 1st, right? But they've accrued all that interest. And so they have to expense the interest in the year or the period that it happened. And so the 4 months of interest, the September interest, October, November, and December interest, all needs to be expensed by December 31st, although it's not going to be paid until January the 1st, right? Way back in chapter 4, when we did adjusting entries, I know one of your favorite chapters, I'm sure. So we expense $4,000 of interest for that particular year and set up the interest payable, although of course we're only going to pay that the very next day, but it doesn't matter. We're closing the books on December 31st. How do we get the $4,000 in interest? $100,000 is the loan times 12%. Remember, just 12% is an annual rate, all 12 months. We only had the note for 4 months of the 12. So that's why we have to multiply by the fraction, 4 months over 12, and that's where we get the $4,000. Probably remember that. Accounting 101. So it's the very next day, happens to be the maturity date, and Cole Williams is going to pay back the note plus the interest. Remember, everything is paid at one time. So they're going to go ahead and debit their notes payable, right? Because that's how you clear up the note. So you reduce the liability. It's also going to reduce the interest payable because they're paying the interest today. And of course, they're going to dole out $104,000 in cash to show they've paid back both the note and the interest on that note. Okay. So hopefully good memories. One of the things that's very important to understand is that corporations and businesses that sell taxable items need to collect sales taxes as part of every sale that they make to customers. So the selling company is going to certainly make revenue by selling what it's selling, but they're also collecting the tax. And so because they're collecting the tax from the customer, that's not theirs. They have to send that to the state Department of Revenue. And so sales tax payable is a very important current liability account that a lot of businesses have. If you have a product, if you're selling something that's a taxable item, you're going to have a sales tax payable account. Okay. Of course, unless you live in certain states that don't have a sales tax. Okay. So we don't live in one. Right. So here's the illustration. It's March 25th. And they are reading the cash register for Cooley Grocery. And they show they had sales of $10,000 and they collected $600 of sales tax because the tax rate is 6% on the sale. So the journal entry in the books would be, of course, they're going to be collecting $10,600 of cash. So they debit cash, but only $10,000 of that is their sale. So they're going to record $10,000 of revenue. The other $600 represents sales tax payable. They've collected that $600, but they owe it to the state. Right. So again, when you start a business, you're going to get a state identification number and a sales number. So you can go ahead and remit your sales taxes, among other things, to the state on a regular basis. Sometimes companies don't ring things up separately. They don't ring up their revenue and the sales tax separately. Sometimes they'll ring everything up with one big total receipt. So if the case that they do ring up sales as a total receipt, how do you know how much of it is the sales tax? They will give you the sales tax, 6%. So what do we do is we take the $10,600, and we'll simply divide that by 1.06, which is 106% of that amount. 100% is going to be the revenue. 6% is going to be the tax. So you will figure out how much is the revenue, and the rest will be the tax. So in this case, you will figure out that your revenue is going to be $10,000. How'd you figure that out? $10,600 divided by 1.06. That gives you the revenue portion, which means the remaining 600 is the sales tax payable. So if you get a question on your homework that they do not ring up everything separate, they sort of give you a total receipt and ask you to figure out what's the revenue, what's the tax, sales tax payable, this is what you'll do. Okay, this is what you'll do. You're very familiar with unearned revenue by now. Again, unearned revenue, the customer has paid up front. You owe the customer whatever they paid for. What are they going to pay for up front? They'll either pay for certain goods up front and you need to deliver them, or they've paid for certain services to be performed up front and you need to perform them. So it starts as a liability, and it's a very, very important one. It's very common. It's very common. It affects so many different businesses. Certainly, the travel industry really goes on. I mean, when you book a trip to Hawaii or anything, or a cruise to the Caribbean, you're paying for that up front. You're booking an airline ticket, you're booking hotels, you're putting down deposits on a cruise, etc. The company is going to be collecting a lot of cash up front, but that's all liability money for them. They are going to say they have the cash, but they have to set up this liability, unearned revenue. Why? Because they owe you. They owe you. Once it comes the time for the plane to leave, once it comes the time for you to start staying at that hotel, or for you to get on the boat to take your cruise, then they don't owe it to you anymore. They can say, okay, it's no longer a liability. We have actually earned it. And so they'll do an adjusting entry for that. So here's the illustration that your book gives. I like this illustration. It's from this superior university. Yes, yes, yes. Please, dot your I's, cross your T's. Please, superior. They sell 10,000 season tickets to their football games, $50 a pop. They have a 5-game home schedule. Okay. So they're selling these up front. So they're going to be collecting a lot of money early on. So that's going to be $500,000 in cash they're collecting, and they're going to set up a liability, unearned ticket revenue, right? That's a liability. They owe those fans the games that they paid up front. They paid the tickets, right? So how are they going to take this? Well, after every single game is completed, remember, this is for a whole 5 games. So every time there's a game completed, they've earned a portion of that, right? So after every game, they're going to debit their unearned ticket revenue, right? They're going to lower the liability, and they're going to move that money into their revenue account, which they call ticket revenue. So that's how the unearned revenues are going to work for there. And this should be a little bit of a review from way back in chapter 4 days. Yes, companies have long-term debt, but the portion of the debt that's due this year is actually considered a current liability. Okay. So again, only the portion that's due this year is going to be part of your current liabilities. Okay. So there's no adjusting entry, nothing that needs to be done. But this is how it works. Here's the illustration. You have a construction company, Wendy Construction. They issue a 5-year, $25,000 note. Okay. And the note specifically says that every January 1st, starting of this next year, 17, all the way up, they're going to pay $5,000 of the $25,000 back. Okay. So what amount of this $25,000 note, which is certainly long-term debt, how much of it is going to actually be a current liability? Well, the portion that's due this year is the $5,000 of that. So 5,000 of that is going to be a current liability. The remaining balance of the loan, which is 20,000, is going to be a long-term liability. So they simply just break it up into what's due this year and what's due after that year, thus long-term. We doing okay? All right. So learning objective 1 ends, well, this is actually a sort of a pause. It keeps going. This part ends with some basic questions to make sure you understand all of that. So again, if you borrowed $50,000 6-month note on September the 1st, what would be your interest expense if you close the books on December 31st? Well, a 6-month note means that if you borrowed it September 1st, you're not going to be paying it back until February 1st, I think, right? October, November, December, January, February, yeah, February 1st. Oh, sorry, March 1st. Can I count? No, I counted all 5 fingers and I said, I'm done. I don't have any more fingers on my hand. So it's going to be March 1st. So you have all of the month of September, October, November, and December. You got 4 months of this note that you have to expense the interest this year, even though you're not going to be paying it until the following year, right? Because notes are going to, you pay everything at once on the due date. So you got $50,000 loan at 12%. Again, this is for the full year. 4 months of that year have gone by, so we can expense $2,000 of interest and set up a $2,000 interest payable to show we're going to pay it later. Okay. Here is a cash register total. This $23,320 has everything. How much of it is revenue? How much of it is sales tax? Well, if the sales tax is 6%, we take the $23,320 and we divide it by 1 point, and whatever the tax rate is, so 1.06. That means $22,000 of that amount is your revenue, and the remainder, $1,320, is your sales tax that's going to be payable. Okay, that's how that's broken up. Total divided by 1 point and whatever the sales tax is. Okay. The last one here is you got $15,000 in advance. So you got an unearned revenue here. You got that in November the 1st, for 3 months rent. So this person paid November, December, and January rent all up front. You're at the end of your year, December 31st. How much of that is yours? Well, you've provided them with November and December. So 2 months of the 3 months you have earned. So you should recognize $10,000 of that as revenue. The other $5,000 is still unearned rent revenue. We were talking a little bit about sales taxes. That's not the only thing that, of course, companies collect and owe. Some of the biggest ones are payroll taxes, and there's a lot of them. So let's talk a little bit about it. First, let's get real on payroll for a minute. Do you know whether you are an exempt worker or a non-exempt worker? Well, it depends on how you were hired. Okay, what exempt means and what non-exempt means refers to a 1935 law establishing a 40-hour work week and overtime rules. Okay, that only applies to wage workers. So that means when you were hired, they quoted you an hourly rate. We would like to hire you at $20 per hour. At that point, you're a wage worker. That law was meant for you. So you are a non-exempt employee. In other words, the law applies to you, which means after 40 hours in a given week, if you work, say, 41, 42, 43, every hour after 40 hours, they have to increase your rate by 1.5 times, right? Time and a half. Well, you could also be hired on either a lot of people are hired on a yearly rate. They say, we want to hire you for $52,000 a year. Well, in that case, you are being hired on salary. You are exempt from the law. What does that mean? The 40-hour work week rule doesn't apply to you. So whether you work 35, 40, 45, 50 hours as a salaried worker, your gross wages are still the same. Okay. So again, many people are hired on salary, particularly if they're in managerial, some administrative positions. They're hired on a salary. That's for the amount of work you're going to be doing, regardless how many hours you put in. So just because you might work 50, 60 hours one week, don't expect any additional money in your paycheck, because that is how you were hired. However, that's not true for a wage worker. because then the rules of overtime apply. So the first thing payroll has to do is determine your gross earnings. Well, for a salaried worker, it's quite easy. You take your yearly rate. Let's go with my $52,000 a year. Let's say they have a payroll of every week. So there's 52 paychecks in every year. Your gross salary would be the $52,000 a year divided by 52 paychecks a year, which is $1,000 gross pay. So that's where your starting point is. For a wage worker, they're going to have to take the number of hours and multiply it by the rate per hour. Any hour over 40 hours is time and a half. So that's how they would calculate their gross earnings. Okay, so it's very important to know that difference. The second thing to understand is that there are mandatory payroll deductions and there are voluntary payroll deductions. What has to come out of everybody's paycheck are FICA taxes. Okay, the FICA tax is for Social Security and Medicare. Okay, and it's just required. It's just required for everybody. It doesn't matter, even if you're working just a couple of hours, if you're only working for a month, whatever, and you're not going to make that much, you still have to pay into it. Social Security is 6.2%, right, of whatever your gross earnings is. And Medicare is 1.45% of whatever your gross earnings come out to be, right? So together it's 7.65%. It's a pretty hefty tax that's required. It goes to fund these two programs. Social Security is, in essence, and most of it is a retirement retirement income program for people who have paid into Social Security and retire at certain ages where they qualify for benefits. Social Security also pays for if those people died and they may have children or a spouse, their children or spouse could benefit from their retirement benefit because they've paid into Social Security. And the last part of Social Security is a disability insurance where, again, you have to meet very high standards to qualify, but you could qualify for Social Security disability insurance. So this tax pays for that particular program. Medicare, now this is Medicare, C-A-R-E. Medicare is when the federal government becomes your health insurance company. They don't become your doctor, they simply become your insurance company for healthcare. The tax, this 1.45% tax, is paid into the system by people who are working. But the beneficiaries of Medicare are folks who are 65 and older. So the only qualification, matter of fact, for Medicare is you need to be 65 or older. There are exceptions for folks who have a disability at a younger age. They could get it at a younger age only for that reason. But in general, that's what it's for. So we do actually have universal health insurance for people in the United States. They're just old people, 65 and older. And that's that. And my parents, I mean, you might know your parents or grandparents might be on it. My parents love it. They have no problems with it at all. Okay. But nonetheless, it is just it's just that. This, again, like I said, is mandatory by law. Other types of things. So if you're if you work quite a bit, then you're going to be subject to federal and state income taxes. Okay, so the federal income tax is again, the federal government, as well as our particular state of New York, taxes your earnings. It taxes your earnings. And so to help you prepare to pay your full tax bill, um, your employer uh, takes out, based on what information you provide to them, whether you're married or single, if you have dependents or not, they take out a portion of that tax every paycheck, and they send that to um, either the federal government or the state government. Social Security, Medicare, federal income tax withholding gets sent to the IRS. The IRS is the tax collector for the federal government. State income tax, as well as the sales tax, goes to the State Department of Revenue, because the State Department of Revenue is the tax collector for the state. So all governments have tax collectors. So that's how it works, right? So again, there are some people that say, well, I'm exempt from federal income tax. Well, you might be if you have a very, very low income, if you're only working a few hours per week, or you only have a summer job and you don't make much money, you might not need to take out the federal income tax or the state income tax. But you have to pay Social Security, Medicare tax. No one is exempt from that. Then there are a whole bunch of voluntary taxes, voluntary deductions, rather, not taxes, God willing. So your contributions towards your health insurance, your contributions towards retirement, if you give to United Way or some other charity through your paycheck, those are all voluntary. Okay. At the very end is your net pay. Your net pay is simply the gross earnings minus all these deductions, both mandatory and voluntary. So this net pay basically comes down to checks that you want to cash, right? Or direct deposits, which require the employer to have cash. So literally, an employer only needs enough cash to meet this part of the payroll. Okay, and you'll see that. So here is Cargo Corporation, and they have a pretty large payroll, $100,000 for the week. So the first thing they do is they expense their salaries or wages of $100,000. Okay. Then you notice they're setting up certain payable accounts, certain liability accounts for the taxes we just spoke of. FICA tax is Social Security and Medicare, federal income tax withholding, state income tax withholding. All these are going to be taken out of your paycheck of employees. The difference is going to be how much money they actually need to pay the net pay, which is the salaries and wages payable. Okay. So when it comes time to actually have your employees cash their checks, this is how much cash you need to meet your payroll. And so in this case, once that happens, your payable goes away because you've paid your employees. Usually the pay date is usually like a week after you've worked, right? And that's how much cash they're going to need to cover it. But it's not all. It's not over yet. Yeah, we've got more. Employers are also subject to other tax based on payroll. So one thing that you might not know is that whatever you put in to Social Security and Medicare, your employer needs to match that on your behalf, but they are matching that. Okay. So you don't see that because that's strictly a tax on employers. That's why it's sort of in dark, bold print here, strictly for employers. So whatever you're putting in, they're putting in. Okay. Secondly, your employers are also required to contribute into the unemployment compensation funds for the state and, of course, the federal program. Now, unemployment compensation fund is basically an insurance. So when you've had a lot of these people that have lost their jobs because of COVID and they apply for unemployment compensation, where does the state get the money? From this tax. Okay. This is a tax on employers for contributing into this insurance pool, because that's basically what it is. And so as people need to claim unemployment, the state has money to pay that benefit to unemployed folks. It is a state-run program for the most part, but the federal government helps out and also contributes to that. And that's what they just did in the last few COVID bills. Big chunks of money are going to states to continually allow them to cut their unemployment checks. Otherwise, they would run out of money. Okay. So how that would work on an illustration, we're still talking about Cargo Corp's payroll. Okay, that $100,000 payroll that we went through, you saw all those different payables. But what you don't see is what the other entry they do for the employer's expenses. They will have a payroll tax expense of $13,850, which can consist of their match for the FICA. They're matching exactly what the employees put in, they're putting it. And then the amount of money they need to contribute to the respectable and unemployment taxes. Federal unemployment is small, state unemployment is larger. This unemployment compensation tax is only on the first few $1,000s of every employee's earnings, and then the tax goes away. Okay, they don't have to pay that anymore. But it's there, and it's there for a reason. Okay. So now we're at the end of objective 1. And let's see how this works here with your, you might be all taxed out by now, but we're going to keep going. Here we have the month of September. Lake Corporation has wages of $60,000. They have $3,500 in Social Security withholding. They have $6,500 for federal income tax withholding, and another $2,000 for state income tax withholding. However, they also have $90 of federal unemployment benefit taxes to pay, and $150 for state unemployment taxes to pay. So the first thing we're going to do is prepare the entries at the end of the month for those salaries and wages. The next thing we're going to do is do the company's payroll tax expense. Right. So the first thing is they just got $60,000 of total salaries and wages expense for that period of time, for September. We already know from the numbers that are given here, $3,500 is going to be FICA tax payable, $6,500 is federal income tax payable, $2,000 is state income tax payable. The difference is going to be their salaries and wages payable. This is how much cash they're going to need for the checks for that payroll. Okay. And then, of course, their payroll tax expense, remember, they have to match whatever you put in, plus their unemployment taxes. So here they have a payroll tax expense of $3,740. $3,500 of that is their match to FICA tax payable, and then their contributions to the unemployment system as well, federal and state. Fascinating. So learning objective 2 introduces us to bonds. So a bond basically is a loan from investors. Everybody talks about the stock market, and the stock market is important. What's equally important in our system is the bond market. The bond market is where investors go to lend money. Who do they lend money to? Corporations are a very large player in the bond market. So is the federal government. We were just talking about the national debt earlier. Well, most of those are in the form of bonds, and so they're a big player in the bond market. But so are state and local governments. They also go to the bond market to borrow money quite frequently. SUNY, it says here university, but SUNY, if you go back just a few years, you can look at every SUNY campus had a new building. We had our dorm and other things on campus here. But every SUNY campus had some new building. Where do they get the money to build all those buildings, right? Well, they borrowed money in the bond market. They promised to pay back over a longer period of time. We have a nice new bridge because the Tappan Zee was falling apart and very dangerous. Um, well, where does New York State get all that money to build that bridge? Bridges are not cheap. Well, the bond market provides financing for that. So bonds are loans from investors. Okay, we're going to focus on the use of bonds by corporations, although they're not the only ones in the bond market. One bond is a loan of $1,000. Okay. Now corporations go and they borrow literally hundreds of millions of dollars at a time. So when you want to be a investor in the bond market and you want to make a loan to a corporation, one bond is $1,000 loan, basically is what it comes down to. Okay. So the corporation is borrowing money. So when they issue a bond, the word issue simply means they're selling a bond, right? They're selling a bond to invest to an investor. So they're borrowing the money. The bondholder is the person that bought the bond or lent the money. Okay. Why would anyone want to lend money? What's in it for them? Okay. Well, bonds work in a very basic way. So let's just say here, you're interested in lending money, right? And again, one bond is $1,000, and we're in 2021. So most bonds are, long term, 10, 20 years, which means that you're going to get your money back in full in 2031. Let's make it a 10-year bond. Okay. So what are you going to get paid back at the end? You'll get your $1,000 back. Well, it doesn't seem like a good idea. I give $1,000 now, then I wait all this time and I have $1,000 back. Well, it's the interest, right? Because these are interest-bearing notes. So let's say this is a 4% bond, get 4% on your money. That means that every single year, and again, this is 10 years, so every single year, you are going to collect an interest on your loan. So 4% on 1,000 is $40 a year. They pay they pay this interest. Oops. I don't know what I just did there. They pay this interest sorry. Oops. I just screwed up. Sorry, are we back together? Can you see me? It's nice to see you. Let me go back. I'm sorry. That's the problem when you start clicking. You know. Okay, so I'm back. Thank God. So you're going to get a payment of interest every 6 months. So these little notches here basically means that for every 6 months over the course of that 10-year period or 20-year period, however long the bond is, they're going to be sending you an interest payment. Okay, isn't that nice? At the very end, when the bond is matured, they're going to send you your $1,000 back with your final interest payment. So what's in it for the bondholder? Well, this string of interest payments over a long period of time. That's what's in it for the bondholder. Okay. So that's how bonds work in general. There are two general types of bonds. Remember, a bond is a loan from an investor. So a secured bond is a secured loan. What's a secured loan? Well, a secured loan means that loan, the issuer has pledged collateral for that loan. So some type of asset is being pledged for that loan. So personally, you might have already had experience like this. A car loan is a secured loan. What you don't know, or maybe what you do know, is that when you agree to accept the loan from the bank, you've also agreed to pledge the car as collateral, which also means in the law that if you do not pay back the lender, you've given them the right to take the car. That's repossession. Okay. Well, in essence, that's what it's the same thing with a mortgage on your house. You're doing the same thing. You're pledging the house as collateral. That's the asset. And if you do not pay back the mortgage, you have given the right to the lender to take the house. That's a foreclosure. Well, in the bond market, when investors buy bonds that are secured bonds, that means the company has pledged assets. And the most common asset they pledge is equipment. Most secured bonds on the market are equipment bonds. They're very common, and that meant that if the if the corporation does not pay the bondholders back, that they've already have pledged that asset as collateral, which means the bondholders literally could sell the asset to get paid back. Okay, so a secured bond is nice for the bondholders because it provides some security that it's not just free money. There's actually something attached to it. It's a little bit different with an unsecured bond. Okay, an unsecured bond is an unsecured loan. So personally, you know a lot about unsecured loans because I think probably everybody here has a credit card. Credit cards are unsecured loans that the bank has made to you through Visa, MasterCard, whatever. Um, how do they come up with the idea that you could have a credit card? Well, they simply looked at your general credit by looking at a credit score and determining based on your credit score whether you're good for the loan. And if you're a little risky, they're going to want a higher interest rate. If you're not so risky, a lower interest rate. Well, corporations have similar credit scores. They're called a credit rating. So corporations will have credit ratings, and these are done by financial companies like Moody's, Fitch, S&P. They do credit ratings. And credit ratings are basically sort of the corporate equivalent of a credit score. The highest credit rating would be a triple A. Then they go to double A, single A. It sounds like a battery, family of batteries here, but it is what it is. Then they go, there's triple B, double B, all the way down to C. And then after C, they do have a category of D. So basically, if you're at the high end, if you have a AAA rating, that's like a person with a really high credit score. A high credit score for a person means that they're very responsible, they're financially safe to give a loan to because they have a history of paying it back. They might have a strong financial position, they manage credit well. Give them the loan, damn it, and don't charge them a lot. Otherwise, they'll go someplace else. However, so a corporation with a very high credit rating, like a AAA credit rating, is a corporation that basically is in excellent financial shape, has a reputation of paying their loans back and being financially strong. It changes as you go down. So as you go down the credit ratings, basically this really means simply less financially secure, more risk. Okay, more risk. Um, well, does it mean that say a company that has a double B credit rating, are they going to be able to get a loan? Yeah, they're still going to get a loan. There's still bondholders that want to lend money to these companies. But certainly because they're more risky than a company that's AAA or AA, they're not going to get as good a deal from lenders. But what does that mean? Well, as the risk increases, so does the price. The price of money, the price of a loan, is the interest rates that we pay. So the difference between, say, a 12% loan and an 8% loan usually is, if it's the same type of loan, usually is that the person who's getting the 8% loan is less risky. The person who gets a 12% loan is more risky. So it means that lenders want to be compensated for the risk that they're taking. So they'll happily lend you the money, but they're going to demand a higher price for that money, a higher interest rate. And that's basically what happens in the bond market as well. Credit ratings determine the price of the money that corporations get, the interest rates they pay. You never want to get something that's a D. The D is a default, which means the corporation has stopped paying either interest on the loan, on their bonds, or they couldn't pay the loan back, couldn't pay the bond back when it was due. So a D is not just a terrible grade, but at least it's a passing grade. At least in the bond market, it is not a passing grade. It is a failing grade for sure. So how much fun are we having on bonds? Another thing, there are some features. I know the book calls them types of bonds, but these are actually features. There's actually something called a convertible bond, which basically is at the bondholder's option. So if you are the lender, you are the bondholder, you have an option of getting paid back with shares of common stock. That's a convertible bond. Hey, I have this $1,000. I know you're paying me interest. I know I'm going to get this $1,000 back, but you've also provided me with a conversion feature that says I can convert my $1,000 bond into 10 shares of common stock. Boom, I want to do that. Bondholder has that option in a convertible bond. So what does that mean? It means the loan has been paid with shares of stock. The bondholder is no longer a bondholder. He or she is a stockholder. And so that's how they work. A callable bond is simply one that can be redeemed or paid early. Okay. This is at the company's discretion. So it's a feature that benefits the company, not the bondholder. Whereas the convertible feature really is at the bondholders. It's a benefit to the bondholder, not necessarily the company. Could be. But that's basically what a callable bond is. It means that the company has the right to pay back the bond early at a specific dollar amount. And that's basically what a call feature is, or a callable bond. Bonds are real. They're real property. You'll get a certificate proving ownership. Most of these are just sort of data entry type of things, but you can get a physical certificate. The amount of the loan is going to be the face value. The date that it's supposed to be paid back is the maturity date. And a bond has a contractual interest rate. They promise to pay you whatever the interest rate is in the contract. Right? So that's important. That's important to know. Bonds sort of they look like this, basically. If you owned a bond, your name and other things would be where the specimen is, okay? So your information would be here. A couple of things is the company that issued the bond is the company that borrowed the money. So in this case, it's International Minerals and Chemical Corporation. That's a tough mix. They're the issuer. They're the ones who borrowed the money. This is the amount of money they borrowed from this particular bondholder who would be listed here. $5,000 is the same as 5 bonds, right? Because each bond is 1,000. So it's a $5,000 bond in total, which is the same as 5 bonds. This company promised to pay 5.7%, sorry, 5.75% interest. That's per 1,000. So for every 1,000, they would get $57.50 per year per $1,000 of interest of bonds that they have. So that's a nice little sum for this company. Okay. And of course, the company will have the maturity date when they're going to be paying the loan back, dated right on the bond here. Okay. Now, this is a very interesting bond in that this has another feature that your book doesn't talk about, but I'll explain it because it's sitting there. It's called a sinking fund. A debenture bond, by the way, is a unsecured bond. That's what they're called, debentures. And so a sinking fund is an interesting feature that a company promises their bondholders. So what the International Minerals and Chemical Corporation has promised its bondholders is that they will put aside a certain amount of money every year into a special fund called a sinking fund to help the bondholders realize that they're going to have enough money to pay this back on time. That's it. It's just a nice little fund. They put money in on a regular basis every year to show the bondholders, look, we're saving all this money to pay you back. No problem. You get your money back on time. We'll be able to pay. So it's just simply kind of a little security blanket feature for that. This is where you're going to get information, but not a lot, like a ton of testing on, but you're going to get information about how bonds work. Okay. So basically speaking, we use present value tables to help us understand what the market price of a bond is. Okay. So in other words, if you're borrowing money in this year, but you're not paying it back until this year, right? So in 2037, you owe so much money and so much interest over time. How much is it worth today in today's money? So the present value tables will tell us how much $1,000 in 2037 is worth in today's money. Okay, and we do that by using a present value table. A present value table is the same as discounting. A future value table is the same as compounding. A lot of people like to do that because, like, oh, if I put money into a stock fund and I wait 30 years, it's going to compound into this much. So they like when it goes up, the compounding. Present value is taking that future value and bringing it to today's money. So it's called discounting. They're related. Future value is the opposite of present value. Discounting is the opposite of compounding. But they work the same. Okay. So this is how they would determine how the bonds would be valued. Okay. So this particular company, and this is for informational purposes, right? So they are assuming that this company is going to issue, remember, issue is to sell, right, to raise money, $100,000 of 9% bonds due in 5 years. So they're 9% bonds. That means that they're going to pay 9% per year on that amount for 5 years. Okay, that's what they've promised here. So again, we are here trying to figure out what all of this is worth when we promise $9,000 a year. And in this case, this bond pays annually. So at the end of every year, they're going to be forking out $9,000 of interest for 5 full years. Right, so that looks like 45,000, 9 times 5. And they're going to pay their loan back at the end of 5 years, which is a $100,000 loan. How much is it really worth today? Well, they use a present value table. They'll look at 9% for 5 years. They'll get a factor. And the present value of $100,000 that's going to be received in 5 years to investors is currently worth $64,993 using that factor. These $45,000 is $9,000 a year for 5 years. The present value of that cash flow over that 5-year period is currently worth $35,000. So together, they're basically worth $100,000 today. Okay. Of course, at the time that they're going to get paid, look, they're going to be paying $100,000 plus $145,000 in total. Right? But this is how much it's really going to be worth today. So that's basically sort of the intro here. Learning Objective 2 is big on terminology to sort of understand. Secured bonds have collateral, so that's why that's true. Callable bonds allow the company to redeem the bonds, which means they can pay them early. That's also true. The contractual interest rate is the rate the investors demand for loaning funds. No, it's the rate of the bond, nothing else. Investors can't demand that. Although they don't like that bond, they'll go to another one. The face value of the amount of the principal is what they need to pay back on the maturity date. Yes, you borrow $100,000, you're going to pay $100,000. You pay interest all the way through, but you're still going to pay the $100,000 back, whatever the face value is. Okay. So All right, here's the fun stuff. How do we actually do accounting for bond transactions? Okay. Well, there's two things that happen with a bond for a corporation that they have to do journal entries. They do journal entries when they issue a bond, which means they're selling it to investors to raise money. They also have to do accounting or journal entries when they redeem the bond, which means they're paying it back. Okay. They also have to do journal entries if bondholders convert bonds to common stock. Okay. So, in essence, the borrowing money and going through Wall Street and the investment banking community, it takes a little bit of time to go through that process. So, oftentimes, when they actually are putting together the contract for the bond and pricing it right, you just got to understand that every day interest rates change. Okay. Every hour of every day, every minute of every day, interest rates are changing. Just like stock prices are changing. Stock market goes up and down. Guess what? Bond market goes up and down all the time, all throughout the trading day. So having a set price is one of the problems of bonds because sometimes you can set a price and it's exactly what the market rate is right now. And so you can actually raise the amount of money that you wanted to, which means you can sell the bonds at face value. $1,000 bond, you can actually sell for $1,000. However, like I said, interest rates change. So let's go with that 4% bond that I was talking to you about from the last objective. And let's say just as we're about to go and sell these, right, to issue these, the bond price, the interest rates on various bonds have changed from 4% to 4.5%. Well, that means that investors can lend money now at 4.5%, and you have a bond that's only offering them 4%. Well, how do you sell something, a 4% bond, when investors can get 4.5%? Well, that means your price of your bond has to come down. And that's what a discount is. That's what a discount is. The only way you get to sell your bond is at a discount. Okay. Why a discount? Because no one's going to want to buy a 4% bond when they can get 4.5%. So, how do you sell a 4% bond? Lower the price so it becomes more attractive, right? That's how you sell anything when you can't sell it. You lower the price. That's a discount. On the other hand, the premium is just the opposite. What if you came out with that 4% bond and bond prices have dropped to 3.5%? So that means investors that are getting into the market today, the best they can do is get 3.5% on their money. And you have a 4% bond. Shit, everybody wants your bond because 4%, much better than 3.5%. Well, you know the way it is when everybody wants something, right? There's a bidding war. So why would you get $1,000 when people are bidding up that price for a bond? So you're going to get more than $1,000 for a bond. That's the premium. That's the premium. So that's basically how bonds sort of work. You either sell them at the value that you came with because the interest rate on your bond matches the market that day it's sold, or you get some variations. If your interest rate is higher, you're going to get a premium because everyone's going to want your bond, so they'll pay more for it. If your interest rate is lower, then who wants a lower bond when I can get a higher rate? So you're going to have to lower the price of your bond to sell it. So that's the discount and premium feature. Bonds have prices. They're priced at a percentage of face value. So 100%, remember, each bond is $1,000. So to sell a bond at face value, you sell it at 100% of $1,000. $1,000 is $1,000, right? If you're selling that $1,000 bond at a lower price, you're selling it for less than 100% of the value. That's a discount. If you're selling it for a higher price, you're selling it at more than 100% of the value. That's a premium. So that's how bond prices work and how they affect these three things that I just mentioned here. Okay. So we're going to move on to some bookkeeping. If you sell bonds at their face value, it's easy. It's very easy. Here you are selling 100 5-year 10% bonds. Remember, each bond is 1,000. You're selling 100 of them. You're selling them at 100% of face value. So you're getting a full $1,000 for each one of these bonds. So your journal entry is simply grabbing 100,000 of cash, and you have to set up 100,000 of bonds payable. So the cash amount is going to be based on the price of the bond. So if you're selling $1,000 bond for 1,000, and you have 100 of them, get 100,000 in cash. Okay. So that's how it works when they're sold at face value, which does happen, but not often. So every year, again, you promise to pay 10% on these bonds. That's a lot. And you have $100,000 of bonds. So every year, you are going to have an interest expense of $10,000 on these bonds. Okay. So assuming you're not paying these bonds until every January, at the end of the fiscal year, you're going to have to make that entry showing the interest that you had to pay or that accrued, and the payable showing you're going to pay it the next period. So that's how that is. How about, oh, well, this is just a follow-up. They paid the interest the very next day. Well, that's easy. You take away your interest payable and you show you paid that interest in cash. So it's quite easy. It becomes a little interesting, again, with this discount or premium issue. So again, let me review what this means, okay? The difference between selling it at par, which means $1,000 bond is worth $1,000. That's how you sell it. Selling it at a discount, which is less than 1,000 per bond. Selling it at a premium, which is more than 1,000 per bond. So let's start here. Most important thing, you have a bond that you're offering at 10%. Okay. So if you're offering a bond at 10%, and when you go to market, which means you go to the market, and the interest rate is also 10%, it matches. So you're selling it basically for 100% of the face value. $1,000 at 10% in a market that all bonds are at 10% will get you the full value of the bond, 100%, 100% of the face value. However, what if you have a 10% bond and you go to the market and the market interest rates are 8%? Well, that means the best every investor can do is 8%, and you're coming in with a 10% bond. Who doesn't want to jump on that? Damn, I want to make 10%. Why do I have to get stuck with 8%? Well, I'm not the only one who's thinking that way. Everybody is. And like I said, if everyone's thinking that way, they're going to start bidding up the price. That's how markets work, right? I want it. No, I want it. I want it. I'll give you more for it. I'll give you more for it. I'll give you more for it, right? Because people want it. Which means that $1,000 bond is going to sell at more than $1,000. That's what a premium is. Okay. So investors are willing to pay $1,100 for a $1,000 bond. Why? Because it pays 10% in a market that has 8% interest. So they are willing to pay more than the face value to get that high interest rate. Okay. That's a premium. The other option is you come to market with a 10% bond and interest rates have gone up. Boo. Which means all investors that want to invest today can get 12% on their money, and you're offering them 10% on your money. So they're not even looking at you. You're like, 10%? I can get 12. Why should I pay attention to you? Well, that means that in order to get anybody interested in lending you money and buying your bonds, you're going to have to discount that bond, which means the price of the bond is less than 100% of the face value. Okay. So again, premium, the price of the bond is more than 100% of the value. Discount, the bond is a less than 100% of its value. And all of it depends on what interest rate the bond is when you come to the market compared to what the market rate is. If you're matching it, no problem. If the market has gone lower, you're going to sell that bond easily because everybody wants a higher interest rate bond. If the market interest rates have gone up and you got a lower interest rate bond, the only way you sell it is to discount it. Again, the purpose of bonds is to get a loan from investors. You still need the loan. Right? So how does bookkeeping work if you end up selling that bond at a discount, which means the interest rate on your bond isn't good enough, right? Because the market rate is higher. So the only way you can attract investors is to lower the price of your bond. Well, how low did you go? Well, here, Candlestick sold $100,000 worth of bonds at 98% of their face value. In other words, yes, they sold $100,000 worth of bonds, but investors were only willing to give them 98% of that because their bond interest rate was lower than the market. So that meant they were only able to raise $98,000 of cash. Okay. 98,000 of the 100,000. That's 98% of the face value. What happened to the other $2,000? Well, that's going to be a discount on those bonds. What happens to discounts is they still going to pay back 100,000. They only got 98,000. They're still going to pay back 100,000 in 5 years. So the fact that they had a discount simply means that the cost of the bonds are higher. Because otherwise they would have liked to have paid 10% on 100,000. They're paying that on 98,000. So, but they still owe 100,000. So clearly they're going to be paying more than the 10% that they promised because they didn't collect everything they needed. So on the balance sheet for those bonds that are sold at a discount, you will actually see discount on bonds payable as an account showing that discount and what the bonds are worth. Again, they only were able to receive $98,000 on $100,000 worth of bonds. They're going to pay back $100,000. So they're going to pay back $2,000 more than what they received, plus the 10% interest every year. Okay, so that means that when they sell a bond at below its value, the cost of borrowing money is more than what they promised to pay. They promised to pay 10%, they're going to pay more than that. Why? Because they sold it at a discount. So it can be a little bit more expensive. Again, you don't have to know this, but this is the math to it. Okay. So when you look at, let's look at the bottom line here. You can do it both ways, but I like this. So they promised to pay back $100,000, right, in 5 years. They're going to be paying $10,000 a year for 5 years in interest. So they're going to shell out $150,000 in cash to these bondholders, paying them back the loan plus interest on the loan. They were able to get $98,000 up front. The difference is their cost of the loan. Okay. So this is a nice little way to do it. This is another way to do it, same thing. But this, I like the bottom part because it tells you this is what they promised to pay back in 5 years. This is their interest rate over 5 years. So that's how much they promised to pay. This is how much they received. The difference is their cost. The discount of that $2,000 in bonds, we actually amortize the differences. So we amortize both premiums and discounts. So basically amortization expense for bonds happens. It's a straight line depreciation method, but we call it amortization. You don't have to know it other than that's what they do. Okay, don't have to know how to do it, just know that it happens. What happens if they go out and they're able to sell their bonds at a premium? A premium meant that they're able to sell their bonds at a higher percentage than 100%. So every $1,000 bond at 100% is face value. At 98 is at a discount, but 102% is a premium. Well, again, they were able to sell $100,000 worth of bonds, but now they sold it at 102% of their face value, which meant they got $102,000 in cash. They only owe $100,000 of bonds back. The other $2,000 is the premium on the bond. The premium on the bond is going to lower the cost of their borrowing because they were able to raise more money than they needed. So that extra $2,000 basically is savings on their interest over the cost of the bond. Okay, so they would actually add the premium onto the bond to show how much they were actually able to raise. And when you sell a bond at a premium at the market, you basically lower your total cost of borrowing the money. Because again, you were able to raise 102,000, you're only going to pay back 100,000, right? Plus the interest. That 2,000 goes to lower your overall costs. How does it work in a chart? Again, I'm going to look at the bottom one here. You promise to pay back $100,000 in 5 years. You promise to pay $10,000 a year in interest for 5 years. So you promised a total of $150,000 for bondholders for that 5-year period. You just received $102,000 selling bonds. That means the cost of this financing is only $48,000. Okay, so it lowers the cost of borrowing for companies. Again, that premium is simply going to be allocated as an expense through amortization. That's all you need to know there. Okay. So how bonds are issued here, we have a quick review. Giant Corporation, they have $200,000 of bonds that they sold for $189,000. So they wanted to raise $200,000. They were only able to raise $189,000. Okay, so they had to sell it at a discount. So what's the journal entry look like? Okay, well, the journal entry is going to be $189,000 of cash for $200,000 worth of bonds. The $11,000 difference is the discount. That's going to increase the cost of borrowing money because they were able to raise that much cash, but they owe that much back. Okay. In terms of how it would look like on the balance sheet, it would be their bonds payable of $200,000 minus the discount. That's all they would show. When they actually pay a bond back, it's pretty easy. Whatever they owe comes out, right? They lower their bonds payable with the debit, they credit cash. And that's basically it. And that's basically what you need to know. Okay. A lot of things going on there, but I hope you followed the story a little bit. I tried to make it into a story that you can follow. So that was the goal. But if you have any questions, I'll take them now.